Hi, you're watching Investor Insights, and in this video I'd like to talk a little bit about the concept of book value. Now, book value, or sometimes it's known as net tangible assets, is the value of a company should you pull the plug and stop the company trading today. And it's very easily calculated by looking at all its tangible assets minus its debts or its liabilities. So this would take into account any of the real estate, any of the computers, hardware, if the hotel or the beds or the furniture, whatever that you can physically grab that's owned by the company, taking away all the debt that it owes. Now, book value is obviously free from things like goodwill, the name. The name means nothing if it became insolvent and had to be all sold off, obviously. So the use of book value in your stock picking methodology sometimes comes into play in determining how much you're paying for a company or its intangibles. So if you find that in periods where stocks are severely beaten, like in downturns or stock market crashes, it's worthwhile looking at book value as a guide rather than things like PE, because they're going to change. When you look at, for example, you would look at, for example, the stock market, the actual share price of the company, and you would look at the net tangible asset per share of the company. So if, for example, the value of each net tangible asset per share of, say, $1, and the share price was trading at $1.10, it means that you're really not paying that much for intangibles. There's not that much goodwill being paid for the business. I mean, $1.10 for $1 of actual hard assets is a pretty good deal. And sometimes in severe downturns or market corrections, you sometimes find bargains like having stocks that are beneath their book value. So for argument's sake, we were looking at QBE during a big correction in 11, and it was running practically at book value. And this was a $16-17 billion market cap at the time. I mean, to buy a large cap stock and pay no goodwill is a good deal, provided that the stock is a stable, solid, growing company. And if you keep that in mind next time you make a stock picking decision, you'll find that it might expose a lot of companies that have too much intangibles or too much goodwill within their price. So you're really paying for an idea or a concept rather than hard assets. So be very, very wary of that.